So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. And one of the strategies that I created years ago is what I call a strategic rollout. Now, that's not a rollover, okay? A rollover is going from the frying pan into the fire. That's people who get duped into putting money into tax-deferred IRAs and 401ks, being told, withdraw your money down the road, defer, procrastinate, postpone paying tax to some future perceived unknown advantage, and then you'll likely be in a lower bracket. Well, I've discovered that most savers in America are not in lower tax brackets when they retire. That most of them kill their tax deductions while they're saving. They're like going down the highway with one foot on the gas pedal and the other foot on the brake pedal. They don't even know they're doing it. The foot on the gas pedal is putting money in tax-deferred IRAs or 401ks, 403Bs, 457s. And then what do? They make sure they're going to be in as higher tax bracket by killing their deductions. Most retirees have their home paid off. They don't have those deductions anymore. The kids are gone. If they move back in as adults, they don't have those deductions anymore. They're not contributing money to IRAs or 401ks. They don't have those deductions anymore. If they had a business, they were a business owner, they sold the business, they don't have those deductions anymore. But most Americans agree that taxes in the future will likely be higher because of irresponsible government spending and the printing of money. So why do you want to continue to defer, postpone, procrastinate paying tax until your account values are this big and then withdraw your money when you're convinced the tax rates will be higher and your account values will be more? That doesn't make sense. So you want to get the taxes over and done with sooner than later. And this is what precipitated converting money in traditional IRAs or 401ks to Roths. It was a windfall for the government. They did it for them, not for us. But it was a step in the right direction because you get the taxes over and done with, and then you accumulate your money tax-free from that point forward, okay? I've never owned an IRA or 401k, I never will, but I've never owned a Roth, I never will, because what I'm going to show you here knocks the socks off of a Roth. And Roths only have 2 advantages, and my favorite vehicle, max-funded index universal life, has those 2 advantages. Your money accumulates tax-free, and you can access your money tax-free, but 4 additional advantages that Roths will never have. And you can search on my YouTube channel to understand those. But let's go into what I'm talking about here. So many people who have their money in the market, their IRAs or 401ks, they are usually convinced to only pull out about a 4% payout, what is called a payout, when they retire. Why? Because it was L.A.S.E.R who discovered, they're a research firm, that if you left your money in the market, okay, and you didn't get upset when the market started going down. See, when there's anxiety, there's opportunity. But people don't understand that. So search my YouTube video about that. But when the market goes down 20, 25, 30%, and you see your $1 million IRA 401k nest egg go down to 600,000, people go, enough already, and you sell low. And then you wait till the markets come back, and then you buy back in high. And so even though they said, if people would just buy and hold, you would average 9% before tax, okay? So $1 million nest egg should be able to generate about $90,000 a year of income before tax, but you're only netting $60,000 after tax in a 33% bracket, okay? Most people are not experiencing that because the investor return is only 3.49% according to L.A.S.E.R because of buying and selling at the wrong time. The financial services industry knows that statistic, and that's why they have what is called the 4% rule. They tell you they tell their advisors to tell you, don't you dare pull out more than 4% of your nest egg a year. If you do, then you have to sign this hold harmless agreement that you won't sue us, the broker-dealer, for you outliving your money. That's pathetic. Why? It would require a $1,250,000 nest egg in order to generate at a 4% payout a $50,000 a year income in retirement. And that's before tax. in a 28% combined federal and state tax bracket. 41 out of 50 states has a state income tax. And so let's say it's not as high as 13.5% like California, but on top of federal rate at 22 or 24%, you're up another 4 or 6%, and you're at 28%. Okay, so at 28% tax, you're only netting $36,000 after tax to buy gas, groceries, prescriptions, golf green fees. To me, that is pathetic. $3,000 a month. I don't accumulate $1,250,000 to have a measly $3,000 a month. And so max funded IUL that has $1,250,000 of cash value in it, without question, our clients, without even rebalancing, can take 8% payout without depleting principal. If they started taking out 100 grand a year at age 65, at age 120, if they were still alive, they'd still have the $1,250,000 or more in there. Okay, that's what I mean by not depleting principal. If you're only earning 3.5% and you pull out 4%, you'll run out of money before, but not before your LE. That's life expectancy, and that 4% rule is designed based on people's life expectancy being about age, 90 to 96. Okay. But in actuality, you can learn on this channel how most of our clients get a 10% payout, okay? By using arbitrage, they get about 2.5% higher. And so that means $1,250,000 can generate $125,000 a year of income instead of $36,000. So that's why I always ask people, why would you generate $36,000 of income when you could generate $100,000 or more? How much more is this 100 or 125 than 30? It's not a little bit more. It's a whole lot more, okay? We had a client come to us when he was age 70 and a half back then. It was at age 70 and a half that you had to start taking RMDs. This was in 2012. What's an RMD? A required minimum distribution. If he did not start taking money out of his IRAs and 401ks at the government life expectancy formula at age 70 and a half, there was a 50% penalty on top of the tax. See, the government wants that money out in tax before you die so they can tax it again when you do die, okay? It's the best savings bond the government ever came up with for themselves, okay? And so he came to us and he had $600,000 that was rolled out of his 401ks into his IRAs. And he said, you wouldn't believe this, but I had $600,000 at the turn of the century, the year 2000. And that $600,000 with my advisor in the market dropped to below $360,000 from 2001 to 2003. And then it came back to 600. Then in 2008, it went down 40% again. And then it finally came back in the year 2012 to 600,000. This is what most Americans experienced over the Great Recession. They were barely back to break even. Now, our clients tripled their money. That $600,000 would have been worth $1.8 million by then. But he came to us, so that's when he first heard about us. Now, his advisor was saying, I don't want to be sued. So I told you the market always comes back. See? Yeah, 12 years, nothing. Break even. And his advisor said, well, only pull out 4% a year. I don't want to be sued for you outliving your money. He realized that was pathetic. 4% of 600 grand was 24,000. That's before tax. In his 33% combined federal and state tax bracket, he had to pay tax of 8,000. He was only netting 16,000 or 1,333 a month. That's pathetic. And he knew it. So we did a strategic rollout for him, okay? We didn't roll the money over. That's going from the frying pan into the fire. That's rolling money out of a 401k into an IRA, postponing, deferring, procrastinating to age 72, 73 now, and then taking RMDs. You're not saving tax. You're compounding the tax. You're increasing the tax, okay? And so we did a rollout over 5 years. Basically, we were able to help him earn an average of 8.25% during the 5-year period. So he was able to pull out 150 grand a year over 5 years. That's 750. So his 600,000 actually grew to 750 while we're doing this, but he pulled out 150,000. Worst case scenario, he pulls out 150 grand a year in a 33% bracket. He pays 50,000 in tax, and he only nets 100,000 to put into his max funded IUL. In 5 years, he has 100,000 a year. That's 500 grand in his max funded IUL. That IUL okay, with an 8% payout is generating $40,000 a year of tax-free income. How much more is 40,000 than 16? But he's actually been getting 10%, okay? 10% is 50 grand, which is 3 times 16,000. But in actuality, we got his 750,000 out tax-free. We do this all the time. And so, because I'm a tax strategist. And so instead of just having 3x, we generated more than 4x. That's by offsetting the tax. He pulled out 150. He netted 150. He didn't have to pay tax of 50,000. How did we do that? Well, I taught him about asset optimization. He owned several rental properties, okay? And he went out and refinanced 4 rental properties, duplexes, because he'd been paying them off the wrong way and realized he was costing himself money, okay? I told him that if that rental ever burned down or was destroyed in a fire or it was vacant because of a recession, I showed him how he could be making money even if it was vacant. And he goes, whoa. Because I said, if you refinance that to $1 million, okay, this is what I do. That $1 million, he was able to borrow on those 4 mortgages on his non-owner occupied rental income real estate at 4.5% interest, tax deductible. That's tax deductible. So he's got a $45,000 interest write-off on 4 properties. Add that up. That offset the tax on the $150,000 that he had to report on his tax return each year for 5 years, pulling the money out of the IRA or 401k. It has to show up on the front page of your 1040 tax return. But he wiped it out with 4 new mortgage interest write-offs of $45,000, okay? So he was able to get his money out of that IRA or 401k with no tax consequence. So what was the net cost in a 33% bracket at 4.5% tax deductible interest? See, he learned how money works. In a 33% bracket, that's only 3%. Because he gets to write off 45, what did he do? He saved $15,000 in actual real money in taxes times 4. Okay, so on each property, he was only paying $30,000 a year in actuality because he got $15,000 back in actual saved money. Okay, now what was he earning on this million in his IULs? He was earning 10, more than 10 and netting 9. How much more is 9 than 3? Don't say 6. 300% more, okay? Every year he took from the 90,000 he was earning on his IUL. If push came to shove, if the property, if the duplex was vacant, he could take out 1/3 of what he was earning tax-free and make the mortgage payment. Hello? He made 300%, okay, on that money. Now people say, well, wait, no. If I hire an employee for $30,000 that makes me $90,000, that's called a 300% return on employment cost. If I bought a widget machine for 30 grand and it made me 90 grand, that's called a 300% return on equipment cost, okay? And so he was making 3 times the cost of the mortgage, okay? 200% profit on his property, even if it was vacant. But the strategic byproduct that came along for the ride is that tax deductible interest on 4 duplexes offset the entire tax on his strategic rollout. So he ended up with $750,000 in his IUL instead of $500,000 at a 10% payout. That's 75 grand a year. How much better is 75,000 than the 16,000 his advisor told him to take with RMDs? We do this all the time. This strategy saved him that $250,000 of tax on the strategic rollout. Okay, so if you want to read that story and learn more, I strongly suggest you study my book, The L.A.S.E.R Fund. This is co-authored with my 2 sons. And this is a right brain, left brain approach. This is 300 pages, jam-packed with information and insights, how to diversify and create the foundation for a tax-free retirement. L.A.S.E.R fund stands for Liquid Asset Safely Earning Returns. Now, it's actually 2 books in one. This side, the white side, is for the left brain learner. It's full of charts and graphs and explanations, 14 chapters. But if you're more of a right brain learner, you learn more by stories and examples, you can just flip it over to this book. And this book is about 100 pages, 12 chapters with 62 actual client stories of how property structure max funded IUL is the dream solution, not just for retirement. It knocks the socks off of IRAs and 401ks, but college funding for your kids, working capital for your business, real estate management, like I just illustrated. Don't miss out. And when you're in there claiming your free copy, by the way, this retails on Amazon for anywhere from $20 up to $60. If you buy it on Amazon, thank you, but you'll probably pay $20 plus shipping and handling. You can just go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I require some skin in the game, but I'll pay for the book. Okay, I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats for your investment. But here's what you can do. When you're in there claiming your free copy, you can register for a free educational webinar that we teach every single week. No cost, no obligation. You can even schedule an appointment right there online with an IUL specialist that I oversee, and they can create illustrations to show you how a property structure max funded IUL works in your particular set of circumstances. And you'll see why it's so important, if you read the book, making sure it's done right. It'll make the difference of over a 30-year period of having 8 million instead of only 4 million, okay? It's critical. So fill in, make an appointment, no cost obligation. This is not about me or us, it's about you and your brighter future.